Hi everyone, we're Group 52 and this presentation consists of 4 parts. My group members and I will discuss them step by step. First, let's talk about what is hostile takeover. A hostile takeover refers to a takeover by acquiring company without the permission of the target company's board of directors, regardless of whether the other parties agrees or not. The two parties use two various offensive and defensive strategies to complete the acquisition and hope to obtain a controlling stake and become the major shareholder. The strong confrontation between the two companies is a basic feature, and because of this strong conflict, the hostile takeover event has always attracted the attention of the entire market. Among them, the Cadbury bidding war has been a hot topic in the past decade. So let's have a look at the timeline of this merger and acquisition timeline. This event started on September 7, 2009. COF put forward a cash and share offer for Cadbury, valuing the company at 10.2 billion. But Cadbury insists that COF offer is too low, and this action made COF very angry and went hostile but didn't improve its terms. So Cadbury rejected the bid and its shares fell 2% immediately. Then on November 18th, unexpectedly, Ferrero and Hershey emerged as prospective White Knight joint bidders for Cadbury. 1 month later, Cadbury issued an official response to COF's proposal, boosting its financial aims and guaranteeing greater payout to shareholders. But COF opted its takeover bid for Cadbury, said 1.52% of Cadbury shareholders had already approved its hostile takeover. And this made Cadbury and Hershey discuss a deal to avoid COF closures together. This bidding war lasted almost 4 months, and finally, on January 19th, Cadbury decided to drop resistance, accept COF 815 pennies per share takeover offer. And next, welcome my group member to introduce the next part.
Well, after know about the timeline, then we discuss the hostile takeover in corporate governance. The benefit of hostile takeover to corporate governance can be concluded that, first, hostile takeover might improve the efficiency of corporate governance. For manners general, we can learn that the management teams is treated by the possible outcome of being replaced, which will improve the work efficiency of the management teams. And as for these companies with lower efficiency may have a lower stock price, which will appeal to companies who believe they may better manage the company. In all cases, after COF take over the Cadbury, it improved the efficiency of corporate governance for both parties. Second, Hart announced hostile takeover can be a way to create wealth of target company and acquire companies. According to Cadbury's 2010 year's financial statement, the Cadbury takeover increased the net income by $9,143 billion. Excluding integration and higher related costs, the Cadbury deal added $260 million to CAP revenue. Next, my group member will introduce the discipline of hostile takeover on corporate governance.
I will introduce the disadvantages of the hostile takeover in corporate governance. So firstly, the management might more focus on short-term interests because management may have different preferences. From Short, Casey, Hall, and Wright's journal, the prospects of a takeover may motivate managers to focus on short-term gains at the expense of long-term investments. For example, it may lead to the impulsion of excellent management. Besides, management might be unwilling to invest more labor costs in the company. So for the second disadvantage is the hostile takeover would reduce the value of target company and increase acquisition costs. Like poison pills may be utilized by target organizations' management team. So according to Casey, Thompson, and Wright, they think the target company may publicly demand the offer or divest important assets to make it less appealing to the purchasing party. And for acquiring companies, a leveraged buyout increases the company's debt ratio because it might be increase the pressure to service debt, making the company difficult to raise capital and potentially exposing the company to the significant debt obligations. So in a word, the hostile takeover can bring a poor financial report. So this is about the first question. Next, Yuheng will introduce the similarities and potential differences in merger and acquisition activities between the great financial crisis and the COVID-19 downturn.
It comes to my part, and I'm going to talk about the similarities between these two special periods facing huge economic downturn. The first one is that we can clearly see there's a reduction in merger and acquisition activities. And we can see it clearly from this page that during the 2008 to 2009, the number of deals has a sharp decrease, and which is quite similar during the period of 2019 to 2020. So this is one point, and we believe that the economic substance of this question is that they're all facing economic liquidities so that they do not have internal funds or external funds, anything to just complete their merger and acquisition activities. This is the first point. And the other point is that no matter they just want to merge, they want to acquisition, they want to restructure their business scope or just their business itself, they just try not to diversify their acquisition. We can clearly see it from this logic estimate that before the crisis and after the crisis, there is a significant downturn of these possibility, and which is right here. And from the EY 2020 Global Corporate Divestment Study, you can see that 72% of the company, they just want to focus their core business. We believe that this economic substance of this phenomenon is that they just do not want to take any risk. They're doing really risky things which may impose a threat to their company's selves. And here is come to my groupmate Chen to complete his part about the differences.
And it's my turn to introduce the potential difference of mergers and acquisition activities between the great financial crisis of 2008 and the COVID-19 pandemic. We can intuitively see in figure 1 that the fluctuation range of the economic crisis from 2007 to 2010 is much larger than that of 2020. This could be caused by the fact that the COVID-19 pandemic is not over yet and the data is incomplete. Second point is the regional difference. As can be seen in figure 2, the number of mergers and acquisition transactions in North America and Europe decreased significantly during the economic crisis, while in Asia and Pacific area, the number is remained the same. But in 2020, the Asian and Pacific area transactions decreased very much. And let's welcome my partner to introduce the gender diversification of boardroom in mergers and acquisition.
Okay, next I will describe the impact of the gender diversity of boards on the merger and acquisition. As you can see, there are 3 points on the PowerPoint, and the first one is that the gender diversity of boards actually affect the bid premium levels. And we found through a study that boards with more women significantly reduce risk in M&A. And in another sample of the international in M&A, and the premium decreased by 32% for each additional female directors of the acquiring company. And the second point is that the gender diversity of boards lead to the high return for bidders. And there is one of the reports pointed out that with the increase of the female directors of the acquiring company, and the return of the bidder will increase by 296% finally, because women are more risk conscious in their acquisitions than men, and therefore they are more likely to warn against overly optimistic takeover assessments. So in M&A project, gender diversity boards may adopt a relatively conservative strategy and reduce the risk of overall acquisitions. And let's move to this slide. And as you can see from this table, and we can clearly see that the number of the female directors is still inversely correlated with the bid premium, and positively correlated with the acquisition firm return. So taken together, the gender diversity of boards do have significantly impact on the M&A assessments. So next we will give a short conclusion of our presentation.
Is the conclusion part of our study, and we believe that our study is actually not sufficient enough, because actually the interpretation of all the economic substance of our answers have never reached consensus, so that maybe our study needs further study to focus on this kind of issues. And thanks all of you for listening.